U.S. crude oil rebounding a bit. This follows what's been a steep sell-off and a close at its lowest level since December of 2021. That took place earlier this week. Worth noting, the S&P energy sector is the worst performer on the week, the month, and as Carl just said, the year as well. Helima Croft, RBC Capital Markets Global Head of Commodity Strategy, joins us now. Helima, good to have you. Can we start off talking about China and Chinese demand, what you're seeing there, since it clearly plays an important role in the price moves of this commodity?
I mean, it is the big story of the year for the oil market. I mean, the reason why oil has been under so much pressure has been underwhelming Chinese demand. So we have seen lower levels of imports into China, significantly lower levels of refinery utilization in China. So this is the story that has given so much concern to market participants. You know, the other story we're watching, obviously, is what's on the supply picture, but it's all giving to concerns that we are going to be in an oversupply situation for 2025. So hence why when OPEC took the step last week of announcing that they were continuing the voluntary cuts of 2 million barrels for another 2 months, the market still remains very focused on the demand side of the equation.
So when you're doing your analysis, how much time do you have to spend on trying to figure out the performance of the Chinese economy in 2025 and what that's going to mean for demand?
I mean, that's always a big part of the work of the barrel counters, is looking at China. I mean, there are other, centers of demand that we watch as well. India has actually looked, relatively robust. But at this stage, I mean, if you're having problems in China, it's very hard to overcome that from a market perspective. So obviously, in the coming weeks and months, we'll be watching not only the sort of import levels into China, but also where the Chinese economy is going more broadly.
Do you factor in different election scenarios in terms of your outlook on U.S. production? Because you have the candidates speaking differently about, I mean, one of them is drill, baby, drill. The other one, not much on oil, although production has done quite well in the Biden administration, even with more regulation and permits.
Sarah, that is such a great point, because I think we've seen a real evolution, frankly, in the Harris position. I mean, Trump has been the consistent drill, baby, drill, American energy dominance. If you look at Kamala Harris on the campaign trail in 2019, she was of the view that you should keep oil in the ground, essentially taking an anti-fracking position. She has now really evolved. I mean, if you look at the debate that just took place, not only was she saying that she was not going to ban fracking, but that actually U.S. production was important for reducing dependence on foreign oil. So essentially reverting back to the old all of the above, view that some Democrats used to hold. So I think we've seen a significant change in the Harris position. I think it mirrors, frankly, also the change that we saw in the Biden position, because yes, they came in very strong on their climate credentials, killed Keystone XL, went back into Paris. But you've seen, as they were facing higher energy prices, telling producers actually here to produce more shale. They actually released from the SPR. They've been very, very focused on using their tools to try to keep as much oil on the market as possible.
Then there's the refining, Helima, and all the capacity that's come online in the last year. What do you think that means for refining margins from here?
I mean, that is something we are obviously watching, and that has been, the products market was kind of one of the early indicators that we were having some demand issues. So clearly, we're going to continue to watch what's happening on the products market, what's happening with demand for diesel, for gasoline. So that is going to continue to be a big story.
Helima, thank you as always. Appreciate it.
Thank you.